Hi everyone, Bill Lethman here for MoneyEvolution.com. In today's video, I'm going to be talking about how to create a tax plan for your retirement. So in today's video, I'm going to be walking through a 5-step process using a video case study. So why is this important and why should you watch the rest of this video? Well, I want you to think for a moment about some of the money that you've saved for retirement. If you're like a lot of people, you might have a lot of that money sitting in tax-deferred retirement accounts, like maybe 401k plans or IRA accounts. And essentially that's money that you got to deduct off your income tax return in the year that you contributed. In exchange for that, you got to enjoy tax-deferred growth over time, and ultimately in retirement, hopefully, you're going to be withdrawing that money and paying taxes later. So what I want you to think about is the money that you have saved for retirement, is that money really yours? Well, the answer to that question is both yes and no. You see, essentially when you contributed that money by deferring those taxes, you essentially went into business partnership with the IRS, where every year the IRS gets to decide how much of your profits they get to keep and how much you get to keep. In other words, what is your tax rate going to be over time? And one of the biggest questions that we want to try to address here today, and maybe one of the biggest questions in helping you put together this tax plan, is answering, will my tax bracket be higher in the future than it is today, or will it be lower in retirement? And I think one of the biggest myths that's out there, at least since the time I first heard about retirement accounts or IRAs, is that we were going to be in a lower tax bracket in retirement, and that it made sense to deduct those contributions off our income tax return today because we're going to be in this lower tax bracket in the future. And again, I think this might be one of the biggest myths. So what I want to talk about here for a moment is a little bit of a history of where tax rates have been in the U.S. and maybe a little insight as to where they might be going in the future. So I want to introduce you to this gentleman right here, David Walker. He was the United States Comptroller from 1998 to 2008. Essentially, he was the CPA for the U.S. government. And after he got out of office there, he wrote a book, Come Back America, went on a couple PBS specials. And he basically says that he thinks tax rates are going to have to double based on the fiscal path that the U.S. government is on. And the reason for that very simply comes down to math. Not surprisingly, I think most people realize that we have this huge national debt, and it gets bigger every single year. This is a chart that goes back to 1950 that shows kind of the virtual explosion of this debt. We're now over $20 trillion on the national debt, and every year we're adding almost $1 trillion to the deficit. In other words, that debt's going up by almost $1 trillion every year. And we have this kind of perfect storm brewing where we have this baby boom generation that's getting older, starting to go on Social Security and Medicare benefits, and that's creating this huge strain on the federal budget. We've got fewer workers that are supporting those people that are in retirement. People are living longer, and we've got, of course, skyrocketing medical costs, which is really contributing to Medicare. But let's take a little bit of a history back here when Social Security started, just to put this in perspective. 1935, we had 42 workers for every one person that was collecting Social Security benefits. Today, that's down to just 3 to 1. And then also looking at, the age to collect is now 62 compared to what it used to be at 65. And of course, people are living longer. 85 is the average life expectancy today compared to the life expectancy at only 61 back when Social Security first started. So again, these are some of the things that are putting the strain on the system. And every year, the Social Security Administration, they put out their report talking about what the future longevity is of the program. And they said that basically now that according to the way the math works, they expect that these trust funds are going to be depleted by 2034. That's not that many years in the future. So how will the government kind of shore up these Social Security benefits? We've made other videos where we talk about some of the potential fixes to Social Security, Medicare. But again, this is not just pertaining to Social Security, Medicare, but it's the entire budget and how are we going to continue to support the federal government. One of the things that's out there that I believe is we've got all of this money in retirement accounts. In fact, as of March 31st, 2018, there's now about $28 trillion in retirement accounts. That's 401ks and IRAs and everything else out there. Most of that is money that's tax deferred that hasn't been taxed yet. So one of the questions is, will there be a chance that the government is going to want to tax that money more? In other words, they've got this huge pile of money out there that hasn't been taxed yet. Could they tax that a little bit more? Well, one of the things that they actually had not that long ago was something called the excise tax. I call it the success tax because essentially, if you had too much money saved up in retirement accounts and you started taking too large of a withdrawal, and too large is according to what the government thought was too large, they would actually tax you an extra 15% on any of those excess distributions, the ones that they thought were too large. And that was basically in effect for about 10 years, from 1986 to 1997, until it was finally repealed. And just to kind of keep that in mind, is that 15% was an excise tax over and above your regular federal income taxes and your regular state taxes. So that could easily push somebody up, even at today's tax rates, up well above 50, 60% or higher in some cases. So that's something that they had. Unfortunately, that was repealed. Hopefully that will never come back. But again, those are some of the things that maybe bounced around there as ideas. Looking historically at tax rates, we actually today, believe it or not, are actually in one of the lowest tax rate environments that we've had, at least in the last 50 or 60 years. In fact, actually from 1932 to 1986, the top federal marginal tax bracket was never less than 50%. So now with the new tax laws that went into effect this year, now we're at about 37.5, I think, is the top federal tax bracket. So much lower today on that upper end. And so that brings us to some of the tax laws that went into effect on January 1st of this year. It was called the Tax Cuts and Jobs Act. We think this actually presents a really unique and very special opportunity for us to do some great tax planning. And this is one of the impetuses for me to create this video here today, is because I do think we've got some unique things that we can look at maybe for your tax situation. So let's talk first about some of the highlights of the Tax Act that went into effect this year. We basically saw a lowering of the tax brackets pretty much across the board. There's a couple small exceptions to that, but pretty much across all income tax brackets we saw a reduction there. Nearly doubled the standard deduction, so that's going to be very important, very big for people that are getting close to retirement, maybe as you're losing some of those deductions, like maybe your mortgage deduction and things, especially going into retirement. That's really big for retirees, the doubling of that. It did eliminate the personal exemption, so you no longer get to take that deduction for you and your spouse and your kids. They did make an expansion to the child tax credit, so a lot of people that previously didn't qualify for that now have that as an opportunity to get a little bit of a reduction there. They did make some limitations to the state and local taxes. So your state income taxes and property taxes, that's now capped at $10,000 a year. So for some people that may be in a high tax state, that could be a little bit of a limitation there. But let's take a look at these tax rates. So again, pretty much across the board, they expanded some of the tax brackets in some case, so you can actually have a little bit higher income that's kept in that lower tax bracket. And again, with the exception of maybe a couple of pockets here that start coming in above $400,000, where you've got some small increments where you might be for just that portion of income in a higher tax bracket. Pretty much across the board, we're seeing some nice reductions there. So let's talk about some of the things that the government controls. We're going to talk about some things that we can control. So the government obviously controls the tax rates, and that could change in any given year. All it takes is Congress to vote on that, the president to sign off on it, and they can change the tax rates. So again, those were just changed as of January 1st of 2018. They can control how much of our income is taxed. So that's what we're talking about with the deductions and the limitations on the state and local property taxes. So not only can they change the rate, but they can control how much of our income is essentially subject to tax. And then they can control to some degree the distributions from a retirement account. So in case you didn't know already, the IRS has a rule called the required minimum distribution rules that you have to start taking money out of your tax-deferred retirement accounts beginning at age 70 and a half. And so that's one of the things we're going to talk about as we get into the case study, is how does that impact those future tax rates. So they can control that. We can control where we save money. We're going to talk about Roth contributions versus traditional contributions versus non-retirement, the three buckets, as we like to say. We can control to some degree the timing of our withdrawals. So although the IRS put some very strict limitations on after 70 and a half, we can have some control over that before that time and preemptively maybe fix some of those potential tax problems that might be coming down the road. And then we can also control when we can collect Social Security, and by doing that, we can control our income. We can also control some of those tax rates, especially as we go into retirement. All right, so let me introduce you to George and Susan, our video case study couple. George and Susan are both 54 years old. They both work full-time, have great jobs. They're both maxing out their traditional 401k contributions. They want to retire at age 62, 8 years from now. They just paid off their house. Their kids are finishing up college, and because of all of that, their cash flow has really started to improve. That's actually something that's pretty typical as people get into their 50s. They're paying off some debts. Their maybe kids move out of the house, and their cash flow does tend to improve. And that's certainly the case here for George and Susan. Now let's take a look at their other income and assets. So again, we said they had great jobs. In fact, their total household income between the two of them is $250,000 a year. They also have total liquid investable assets of $1,750,000, and that's split between some bank savings and non-retirement accounts. They also have their 401k plans at work. And then Susan also has an old 401k plan that she rolled over into an IRA account. So we're going to talk about some strategies of what she might be able to do with that also. The next thing we want to do is we want to start to look at those assets and separate those into what we call are the three primary tax buckets. And this is certainly something that you can follow along and do with your own assets as well. But the first bucket that we want to look at is called the tax now bucket, or where your non-retirement accounts are. And for George and Susan, again, they have $350,000 in that bucket. You know if you've got money in the non-retirement bucket if you get that 1099 form every year. And that's going to be your dividends, your interest, your capital gains, and any thing that those accounts make on an annual basis, you're going to have to pay taxes on that. The second bucket is what we call the tax later bucket, or your traditional IRA or 401k accounts. And for George and Susan, that's where most of their money is. In fact, that's what we typically find is that a lot of people have the majority of their retirement assets in that traditional bucket. So $1,400,000 there, and that's money that typically gets contributed on a pre-tax basis, grows tax deferred, but then ultimately you'll pay taxes on whatever you withdraw out of that account in retirement. That's also going to be the amount that, or the accounts that are going to be subject to those RMD rules, which we're going to talk a little bit more about as well. And then the last bucket is what we sometimes call the never taxed bucket. That's something we use kind of tongue-in-cheek. It's not really totally accurate because, of course, the monies that go into the Roth accounts are taxed first, but then they do grow tax-free and are withdrawn tax-free as long as they meet the IRS's definition of what's called a qualified distribution. And George and Susan don't have any money in that account, primarily because they make too much money to contribute to a Roth account. But stay tuned. We're going to talk about a couple of strategies that even though they're over those Roth IRA contribution limits, they can still get money into a Roth. In fact, that's going to be one of the primary strategies as we get into those 5 steps that we're going to talk about here. Now let's talk about where their money is going. So we talked just in the last slide about where their money currently is. Here we're going to see where is that money going on an annual basis. We talked about their 401k contributions. George and Susan have $49,000 a year going into those traditional 401k accounts. And they're maxing those out according to the IRS rules for 2018. The tax now bucket is where some of their excess surplus of cash flow is going. So again, we said their cash flow is improving. So after they maxed out their 401k, they still had some money left over. Any of those monies are now going into that traditional or that tax now bucket there and building those account balances up. And again, nothing is going into the Roths at this time. So let's talk about some goals that we have for the case study here. And these are some goals that you might want to keep in mind too as you're putting together your tax plan. First of all, like I said before, one of the most important things to understand is what is your tax bracket today versus what is that tax bracket going to be in the future. And forecasting that or getting some ideas is probably the most important thing to know as you're putting together this tax strategy. We also want to look at how do we create a little bit more balance between those 3 primary tax buckets. This is going to be especially important as you go into retirement because we want to have a little bit of what we call tax diversification. If you want to take a distribution, maybe you want to buy a new car, take a vacation, having money in all 3 buckets gives you some choices as to where you can take that distribution and what that's going to do to your income tax bracket, income tax not only at that time of taking the distribution, but also what is that going to do in the future as well. We also want to look at those RMDs. We want to understand a little bit about how the growth of especially those traditional accounts is going to go and what those RMDs are going to be in the future, what that could do to your tax bracket down the road, and if we can, maybe try to reduce the impact of those RMDs on the tax situation in retirement. And then last but certainly not least, we also want to look at the other thing we can control, which is your Social Security, and how do we coordinate the Social Security not only with your cash flow needs in retirement, but also with that tax strategy as well. And so with that, let's talk about predicting your future tax bracket. So we talked about George and Susan. Their 2018 total income was $250,000 for the year. We're going to say that their taxable income, the amount that's subject to tax, is $226,000. And all we did there was we just subtracted the standard deduction off of that total tax. And so we kept things pretty simple here. You might have an income that's higher or lower than that. You may have more deductions than George and Susan, but this is just going to give us some frame of reference as we're looking at some of these things here. So this is the tax table that we had pulled up earlier, and what we want to do here is we want to see where George's taxable income of $226,000 falls not only into this year's tax rate, but also where that tax rate fell for 2017, because in 2025, we're going to go back and sunset back to those old tax laws unless Congress does something and changes the rules again. But that'll at least give us some perspective as to what the future tax rates are going to be. So Georgia's tax rate or taxable income of $226,000 falls right into the 24% tax bracket. In fact, they could make all the way up to $315,000 under the new tax laws and still be in that same bracket. Under last year's rule, they were actually pretty close to the upper end of the bracket. So under the 2017 tax rates, they were at 28%. But if they made just $10,000 or about $10,000 more, they would have actually gone into that next bracket, which would have been the 33% tax bracket. So, so a couple things to think about is not only, what is that tax rate today? What is the tax rate going to be once those rates sunset? But we also want to think a little bit about what your income is going to be or likely to be in retirement. So they're making taxable income right now of $226,000. They would actually, even if we went back to the old tax rate, have to go all the way down below $165,000 to go into that next lower tax bracket. So that might be the case for George and Susan, but we're going to assume that they want to keep their income, or at least their standard of living, pretty consistent in retirement with what they had while they were working. And I think that's going to be typically the case for most people as well, that most people we don't see jumping into one tax bracket or another just because they're in retirement, unless they're very close to the bottom end of one of those brackets. All right, so now let's talk about the strategy. What are the 5 action steps that we can look at for George and Susan? Some of these action steps might apply to you. Some of them may not. Maybe all of them do, or hopefully at least a couple of them do. But anyway, this will at least give you some idea of some of the things that we're thinking about as we're helping somebody create a tax plan. So number one is we want to look at where you're contributing your money. And for George and Susan, remember the majority of their savings was going into those traditional retirement accounts, $49,000 a year. The limit is $24,500 per person. So again, doubling that, for George and Susan gets you up to that $49,000 limit. And again, what that's doing is it's putting a lot of money into traditional accounts, and those balances are building up, and that's going to potentially create a big tax issue for them in retirement, especially once we start looking at the required minimum distributions. So instead, the recommendation might be to look at contributing to a Roth 401k plan instead of the traditional 401k. Now, not all 401k plans offer a Roth, but we're finding that most do now, especially if you work for a bigger company. Hopefully your plan does, but if you have a lot of your retirement savings in those traditional accounts, maybe rethink that and maybe contribute to the Roth instead of the traditional accounts. Strategy number 2 is we want to look at, are there any opportunities to convert some traditional accounts over to Roth accounts? And if you remember George and Susan's situation here, we look at their assets. Susan has that old 401k plan that's now an IRA. So that would technically be the only balance that she would be able to convert over to a Roth, but we want to look at if we took that $200,000 and converted it over to a Roth. And again, the idea with that is that we're in a 24% tax bracket for George and Susan today compared to a 28% tax bracket of when those rules sunset. So even if tax rates just go back to the old rules, they're looking at potentially a 4% reduction in taxes by paying the taxes now instead of waiting and paying the taxes later in retirement. And again, that's not even taking into account the possibility, like what David Walker was suggesting, that tax rates could go up a lot. So here we want to look at converting that. And what we want to do is maybe not necessarily convert all $200,000 of that IRA account over immediately, but we want to see, where they're at, again, inside their tax bracket, and maybe phase that in over a couple of years. So if we added $200,000 to their taxable income, that's going to put them up over $400,000 of taxable income. The 35% tax bracket, that's something that we just don't want to do. So what we want to do is we want to see how much room is there in your tax bracket or in their tax bracket. So again, they have $226,000 of taxable income. The upper end of their tax bracket is $315,000. So that's the point where they would shift from going out of that 24% tax bracket. And remember, last year, 2017, they could have only made about another $10,000 or $12,000 before they got into that next tax bracket. So again, that's why this Tax Cuts and Jobs Act is really, I think, a very special opportunity. So for them, they could convert up to another $89,000 from their traditional to a Roth and still only pay taxes at that 24% tax bracket. So for George and Susan, again, the strategy here might be to phase that in, recognize where we're at in the bracket, how much room do we have, and maybe do that over a 3, 4, even a 5-year time period. But again, we want to do it before 2025 because that's when those Tax Cuts and Jobs Act tax rates sunset. Number 3 is we want to look at the Social Security strategy that you have, and in particular, how that Social Security strategy impacts your taxes. So one of the big mistakes that we see all the time is that people retire and then immediately, as soon as they're eligible at age 62, they go and turn on their Social Security benefits. In fact, actually, according to Social Security, we know that's what most people do because that's what Social Security reports, is that a lot of people just turn on those benefits right away. But by delaying those Social Security benefits to at least your full retirement age, which for most people probably watching this video is probably going to be age 67, that's going to give you, as long as you have some good longevity, probably higher long-term lifetime Social Security benefits over your entire life. And not only that, but it's also going to allow us to do some other tax planning, which we're going to talk about here in a moment, but to keep you in some lower tax rates early in retirement so that we can look at Roth conversions and some other strategies to maybe shift, again, our assets that we have and maybe even out some of those tax buckets. So number 4 is exactly what we're just talking about there, shifting some of those non-retirement assets to tax-advantaged retirement accounts. There's a couple different ways to do this, but if you think about it, any money that you have in that tax now bucket is really the most inefficient of those 3 tax buckets because, again, because you have to pay taxes every year on those account balances, those accounts are never going to grow to as large of a balance as an account that's either tax deferred, as in the case of the traditional accounts, or the tax-free accounts in the case of the Roth. So a couple things you can do is we're going to talk about the backdoor Roth strategy. So again, we talked about George and Susan. They made too much money to contribute directly to a Roth, but there is a way that you can still do that. So I'll talk about that here in a moment. We're going to talk about an after-tax conversion. That's something special that some 401k plans allow their employees to do. I'll get into a little bit more detail on that. And then the other thing I won't get into as much detail on, but HSAs, the health savings account. So that is an account that you might have available to you through your employer. And it's for high deductible insurance, health insurance plans, can allow you to put money into this HSA. And that's what we call double tax free because you not only get tax deduction as the money goes in, but as long as the money is withdrawn for qualified medical expenses, you're not paying any taxes on the gains along the way either. And let's face it, we all know that healthcare costs are going up, and in retirement in particular, as we get older, we have a higher need for some of those healthcare services, and having some money in an HSA is a great way to help fund some of those healthcare costs for your retirement. So let's talk about some of the Roth IRA rules, and one of the big ones is the IRA contribution limit. If you make too much money, the IRS says you can't contribute directly to a Roth. So for single tax filers, if you make over $120,000 a year, your ability to contribute starts to get phased out. And then over $135,000, you just can't contribute to a Roth at all directly. If you're married, filing a joint tax return, that starts to get phased out at $189,000 a year. And at $199,000 or above, you can't contribute directly to a Roth. So for George and Susan, having taxable income of $226,000 a year, they do not qualify for making a contribution to a Roth IRA. But what you can do is you can do something that we call the backdoor Roth strategy, and it's to make a non-deductible contribution to a traditional IRA account and then immediately convert that over into a Roth. There is something called the pro rata rules that apply to this. So I'm not going to get into all the details, but for George and Susan, this is something that George can do, but for Susan, it's going to get a little bit more complicated because she already has that traditional IRA account. The IRS is going to look at all of your IRA assets as one account. So even though you might make a non-deductible contribution to a regular IRA, they're still going to look at it as that is one piece of an account that includes that $200,000 that Susan already has. Gets a little messy. I've got some other videos that I get into the details on that, but it's probably not something that you want to do if you have existing IRA accounts. But for George, because all of his retirement accounts are all in that traditional 401k, those pro rata rules are not going to apply to George. So he can contribute, because he's over age 50, he can contribute $6,500 a year to that Roth. And that's something that he can maybe use some of those non-retirement accounts to fund that Roth contribution strategy. Another one that's really great, and this is something that more and more 401k plans are offering, and it's something that they don't really talk about a lot. So your 401k might have this, and you might not even know that they have this, but in 2014, the IRS made a clarification on which was previously kind of a gray area. And what they said with IRS Tax Notice 2014-54 is if you have money in an employer-sponsored after-tax retirement account, you can now roll that over directly into a Roth IRA account. And as soon as I saw that, we started immediately talking to clients about that. We think it's one of the best things out there. We're here in Detroit. We've got a lot of automotive companies, and those companies offer this for their plans. So Ford, GM, and Chrysler, they have this after-tax savings account, and it's an opportunity for people that don't qualify for a Roth or maybe are already maxing out some of their other contributions. They can get some money into this account here. And again, not all 401k plans have this, but it's definitely something to look at. So how much can you contribute? Well, the IRS, of course, has their contribution limits, which we know are for people over the age of 50, $24,500 a year. That's how much you can contribute to either the Roth or the traditional 401k. If you're under 50, that's set at $18,500. Those are the 2018 limits. Those generally go up every year or two as inflation kind of factors in there. But your total contribution levels are set by the IRS at much higher levels. So for people under the age of 50, that's set at $55,000 per year. If you're 50 years old or older, it's set at $61,000 a year. And so how this works is it's going to be the combination of your traditional or Roth contributions. You have to add in any match that the company's putting in on your behalf, and then whatever that difference is, you can put into, according to the IRS, money into an after-tax account. So let's take a look at an example because I think it'll make a lot more sense here. We're going to assume if you're 50 years old or older, the maximum contribution into the plan is $61,000 a year. We're going to assume that you're maxing out that $24,500 into either the Roth or the traditional. The employers are matching $6,000, let's say hypothetically, and that leaves $30,500 that's eligible according to the IRS rules of how much could go into that after-tax account. Now, your employer might have their own set of rules or restrictions. I know some of the companies around here, they limit that to not the amount the IRS says, but they limit that to 10% of your earnings can go into the after-tax bucket. So there are some other restrictions we need to keep in mind there. But basically, for George and Susan, what they could do is they could contribute, George can contribute some money to this account and then roll that balance over directly into a Roth IRA account on an annual basis and get some more money into those tax-deferred accounts, and maybe even use some of the non-retirement account assets to kind of fund any cash flow shortages that he has by putting more money into the plan at work. So it's another opportunity to do that. I do have a slide here for the HSA contribution limits. So again, this is something that you have to have a high deductible health insurance plan, but the limits, if you're single, $3,400 $3,540 per year, and if you're on a family plan, it's $6,900 according to the 2018 rules. So there's another chunk of money that you could put in, use that as a tax advantage for your health savings and also to fund some of those health needs in retirement as well. Okay, so let's recap what we just did here with strategy number 4. If we look at George and Susan, George can use the backdoor strategy to contribute $6,500 a year to his Roth IRA account by first contributing to a traditional, then immediately converting it over to a Roth. We're going to assume that maybe George has the ability to use that after-tax strategy through his company's 401k plan. If his employer let him do 10%, he could do $16,000 per year, contribute that to the after-tax through his employer, and then once a year or so, roll that money out of the employer-sponsored after-tax account directly into his Roth IRA. That's per that tax ruling that happened in 2014. And what we're going to try to do here is maybe use some of those non-retirement assets to fund this whole strategy, because all of a sudden we start contributing money to a Roth and then you're doing an after-tax. That might leave George and Susan a little bit with a shortfall in their cash flow. But again, they have that $350,000 in those non-retirement assets they can use and spend some of that money, but shift that money into being a little bit more tax efficient. Okay, so now let's wrap up and start talking more specifically about creating your tax plan for retirement. There's 4 things that I think you're going to want to do. Number 1 is you want to have a pretty good idea of what your retirement expenses are. And we've got some tools available on our website to help you do this, but that's going to be very important to know how much your retirement could cost. Number 2 is we want to anticipate some of those cash flow needs. Those cash flow needs are going to go into the withdrawals potentially that you need to take out of those retirement accounts. The withdrawals are going to also dictate your taxes that you're going to have to pay on those distributions as well. We want to look ahead to your required minimum distribution. So along those lines, as you're starting to take money out in retirement, how much money is left in those retirement accounts, and what are those forced RMDs going to be after you reach 70 and a half? And will that potentially push you up into a higher tax bracket? And then finally, last but certainly not least, we talked about this earlier, probably the most important thing to understand, and it requires you understanding those first 3 elements as well, but what is your tax bracket today versus what is that tax bracket going to be in the future? And that's where a lot of that planning comes in. So we have a tool to help you with all of this. It's called Wealth Vision, and if you've watched any of my other videos, you might have heard me talk about it before, but it's our comprehensive financial planning tool. And there's 5 very specific things that we think Wealth Vision can do for you. Number 1 is to help you get organized. So if you're like a lot of people, you might have a lot of different financial resources. Maybe they're scattered in a bunch of different places. Well, we have a very specific way that we're going to help you organize that information in a way that's going to be easy for you to understand, and it's going to help you make more confident decisions about all of the other things pertaining to your retirement. Number 2, very important, is we're going to see if your retirement's on track. You know, if you're on track for meeting some of your financial goals and the lifestyle that you want to achieve in retirement. We're going to identify your gaps, so if there are any shortfalls, we're going to identify those. The earlier that you get started with the financial plan, the smaller changes that you can make that are going to hopefully put you on the right track for eliminating or reducing some of those gaps in your retirement. We're also going to get into some of the things we talked about here today. We're going to talk about your tax rates. What are your tax rates today versus what are your tax rates in the future? Again, that's one of the most important things to understand, and it's going to go into your saving strategy. Should you be putting money into a Roth or a traditional account? Those are all the things that we're going to look at. And then last but certainly not least, since we're talking about taxes, we're going to walk through that 5-step action plan to look at how we might be able to help you create a plan for your taxes in retirement as well. So if you're interested in that, we offer a free, no obligation introductory call. That's with me. Generally, we spend about 15 or 20 minutes. Answer any questions that you have. We'll talk about a little bit about your situation and what Wealth Vision might be able to do for you. And quite honestly, if it's a fit, we'll talk about some next steps and what we might do to go forward. So if you're interested in that, you can call our office at 248-731-7829, or we'll have a link right below this video. If you click on that, it'll offer some additional information about Wealth Vision and the opportunity to schedule an appointment right through our online scheduler. So I hope you got some great value out of today's video. I know this was a little bit longer than some of the other videos we've done in the past, but lots of great information. And again, I think we've got a very special opportunity right now with the current tax environment that we're in. So with that, have a great day, and I look forward to seeing you back in one of my next videos. Thanks.